Tip number 1 to protect yourself against a future vol-apocalypse event is don't short volatility with naked or undefined positions. This is always a tough one to convince people of because, of course, when the market is cooperating and everything's going as planned, naked shorting of volatility can be very profitable, and it certainly seems like easy money. There are traders who like to short the volatility ETPs like VXX and VIXY, or short the 1.5 times leveraged UVXY. Again, if you catch a good market period where there's no major volatility spikes, then yeah, it does feel like money's falling from the sky. But when things go wrong, your problems can amplify in multiple ways very quickly. First, the fees are always expensive, but they get astronomically high in a crisis and can easily get to 20 or 30% annualized. Second, it's an unlimited loss position, so if it's a liquidity crisis or a flash crash, you can lose hundreds of percent of your original investment. Even if you just put 20% of your portfolio at risk originally, that could amplify to over 100% losses and your entire portfolio is gone. You owe the bank money. Third, the shares you borrowed can and often are called away on you during that crisis. So you won't even have the opportunity to fix a trade that's going bad. It's just closed out on you. And lastly, brokers will raise margin requirements in a crisis, which can easily put your portfolio in an unexpected margin call. Things can very easily go from bad to worse, and then from worse to, oh my God, what have I done? So don't ever short the volatility ETPs directly. Another thing that applies under this tip number 1 is don't sell naked option positions. We call this picking up pennies in front of the steamroller. It might seem like you're getting paid these really big premiums for selling naked calls or selling naked short straddles, but you have to remember that the options market is efficient. The only reason those premiums are juicy in the first place is because the risk of catastrophic loss is always lurking. If it wasn't, those contracts would only be paying you a penny or two. Stick to butterflies, verticals, long-dated long put options, or out-of-the-money iron condors and calendars. These are all structures that you can layer with higher trade frequency, make a great profit from, but also have defined risk built right into the trade. Even for the best traders, they're called black swan events for a reason.